Insurance cost pressure will ensure acceptable automated vehicle safety. Truth or myth? This one's a myth. The question is how much leverage insurance costs have over safety in practice. Let's take a look at the industry to see how this works. In 2020, there were $1.35 billion in insurance losses. Now, the premiums paid are a bit higher than that, but this gives an idea of the actual cost of having losses for conventional vehicles in the United States in that year. These can be broken down across things that involve harm to people and involve harm to property. 40% of the costs were injury and medical losses, which means 60% were things other than injury and medical losses. In the 2020 statistics, there were 2.9 trillion vehicle miles. That's a lot of miles. There were 268 million vehicles. There were 6.8 million collision claims. There were 810,000 vehicle thefts, and there were almost 39,000 fatalities. While that's a lot of loss of life and should be improved, if you look at the numbers, it's a very small number of events compared to the number of other types of claims, the number of vehicles, and the number of miles. If the cost of the fatality claims is small compared to the overall picture, then a change in fatalities will not be a really big driver in insurance premiums and insurance cost. The problem with assuming that insurance prices will force safety is that insurance isn't about safety. Insurance is about spreading the cost of risk across all the people who are driving. And a lot of that cost doesn't have anything to do with harm to people. It has to do with the cost of harm to property. Some companies will say we're safe because we bought insurance. But the issue is if you're running a fleet of 10 or 100 or even 1,000 robotaxis, it isn't that many vehicles, so that limits the exposure to bad things. And also, typical insurance company policies have a maximum payout. So if that limit is, say, $10 million, the company knows no matter what, they're only out $10 million. Well, that sounds like a lot of money. When you're insuring hundreds of millions of vehicles and trillions of miles as an industry, it's actually a very small fraction of the total payout. So the companies may issue insurance policies because they're trying to gain market share, not because they think they'll make a profit on insuring a handful of cars. Another issue with insurance is that affordable risk might exceed everyday safety. As an example, military personnel serving in combat zones and in combat roles can get life insurance that pays out even if they're killed in a military action. Most people would say that being involved in combat is not on a par with everyday civilian risk, but you can still get insurance for it. The fact that this surprisingly affordable insurance exists tells you that just because you bought insurance does not mean you're doing something safe. Insurance is about pricing risk, not about safety. While insurance companies like to promote safety, and that's a great thing, ultimately they price their policies based on the expected payouts. If customers want to do risky things, they can pay increased premiums and take those increased risks. So it's not about, hey, I have insurance, it means I'm safe. It's about the insurance company being able to predict in advance how risky the thing is you're doing and issue a policy with a premium that reflects that risk. So just because your insurance is affordable to you does not mean that the net safety from that activity is going to be acceptable. Beyond that, net risk alone is also not safety. Insurance is about the net risk. It's the number of payouts compared to the amount of premium, and as long as the premium is higher than the payouts with enough margin to run the business, the insurance companies are happy. There's also things like redistribution of harm. What if more pedestrians or cyclists die? What if more mishaps happen in historically disadvantaged areas? Those disproportionate effects to vulnerable populations are not going to be reflected in insurance premiums, which are just about the total cost of the harm compared to the total cost of the premiums. There are also negative risk externalities which don't involve insurance at all. Blocking fire trucks, blocking ambulances is unlikely to have much of a direct effect on insurance, but can definitely have an effect on things like emergency services operating in a city. And what if known significant risks are unmitigated? What if the total fatalities decrease even if there's a known defect in the software? Is that okay? Well, Net risk won't reflect that situation, but there are plenty of instances in which a misbehaving robotaxi or misbehaving automated truck are going to be a problem, even if the net risk has been reduced by the technology. There are also fatalities due to breaking traffic rules. Humans break rules too, but they're held accountable via negligence. They can have civil lawsuits against them. Their insurance premiums can go up because they misbehaved. And the fact that they can still get insurance doesn't mean that they're safe drivers. It means they're paying higher premiums. So the fact that you have insurance and the fact that the insurance deals with net risk does not address all the aspects that are required to be acceptably safe. The takeaway is that insurance pressure alone will not ensure acceptable safety. More than insurance pressure is required.